Hello everyone, this is Jan Kotze, also known as Bear Bully on YouTube. What's the purpose of today's video? We are looking at ProRealAlgos.com. He has got a package of algos. There's about 27, 29 of them maybe. I can't trade myself two of them, being in Australia, and we're not allowed to trade through my broker any European indexes. So that's the MIB and the CAC. Um, with this package of algos, the founder of the website, Carl, has started the Capital Climbing Club, and the purpose of the club is to guide you to make $1 million using, or let's say, 1 million units of whatever currency you trade in, um, with the starting capital that is available to yourself. Now, looking at this chart here, um, his tool is determined with a 14,900 starting capital and a 33% drawdown tolerance. You should get these returns. This settings here basically give you um, a setting to take 1 unit of risk in every algo if you consider 1 unit of risk as per the DAX index. Now, given that the DAX and the NASDAQ trade sort of similar levels, 1 unit of risk is one in each of them. In the S&P 500, it is $3 per point, and in the Dow, it's a half, and within Nikkei, it would be a quarter. Um, what else? Oh, and in gold, it would be 8 units of risk. So, the first thing I would like to address is this equity curve that's on his webpage. Is it a fair comparison to compare it to a NASDAQ buy and hold investment? Because you can see how it significantly outperforms it. Now, there's marketing and there's statistics. And if you were to look at this, because this is really there for marketing purposes, you might easily make the mistake to say, this is definitely something you should do. You should go and invest your money to let all the algos do the trading for you. However, I feel this is an unfair comparison um, because in my experience, I've seen that the algos will enter into positions up to 17 units of risk at the same time. And of course, if you were to risk 17 times more than another investment where you've only invested 1 unit of risk, you will get massive outperformance. So the better thing to do is to look at the algos individually and decide which of them is creating positive alpha. Is each of them on their own merit outperforming a buy and hold investment in the same index that that algo is trading in? And that was the approach that I took in designing my spreadsheet, and to then be able to construct, so which algos am I actually going to place in my portfolio to achieve this 1 million unit target over whatever time period, and how will that then compare to trading the full portfolio? How much time does it add or take away to reaching the million? And what is the drawdown that you're going to experience? Because drawdown is what might take your eye off the ball and force you to exit this objective prematurely, and thereby, in the long term, harm you. So let's move over to the spreadsheet now. There's just one other thing I should discuss, and that is there's two algos in this portfolio that trade short only, and that is the bottom two over here. the plus Nikkei M5 and the cut stacks M5 short or S. Um, you cannot measure these algos against the buy and hold because indexes over the long term go up, and so therefore short algos are tactical algos. They are there to hedge risk, and they are there to certainly not to hold for the long term, given that that's just not what indexes do. So they are only going to be considered to be included to serve as vehicles to minimize drawdown. Um, Now, what I've done here is I've tested each algo. I took the first trade it took and then looked at the index value at that time to create a start index value, then a termination value as at the 18th of August, and that then gives me my buy and hold return. The This is then assessed against the algo's performance, which was also run to the 18th of August, and we were then simply dividing the equity plus capital, including your capital, the gains and the capital, by the buy and hold return, including the equity that you would have, similar equity that you would have started with. So the green ones are then listed here first, and the yellow ones is included towards the bottom. SP500 Smasher M2 is also included. It's actually not an algo available from ProReal Algos, but from someone else. I'm sure if you Google it, you will find it. And the last thing I'll say is the yellow algos was included, the ones with a yellow alpha, because they just missed the mark of creating positive alpha. So if you have a return over 100%, you are doing better than the buy and hold. I included them based on the fact that they were generating strong P&L, and their time and market was sufficiently so that they then shouldn't be necessarily negatively excluded from the exercise because um, they just barely missed the mark. Okay. Um, I created a factor where I adjusted the return of the algo by the time and market. And the higher the score is, the stronger the indication to then include it in the portfolio. There are two exceptions, which is these gray ones here. They've got fairly low scores. However, the equity that they created was very high. So for that reason, I still included them. The other thing that we should look at is how many of the algos are long only. Um, because when the market experiences a drawdown, if you've got too many long only algos, there's no way you are not going to avoid this drawdown. So for that reason as well, I'm quite happy to exclude some of the algos that aren't doing so well because it helps me just reduce the number of long only algos. Okay. Other than that, everything really goes on merit, and the spreadsheet was then constructed so that I could um, plot the performance over time and see what will happen if I include and exclude algos. This is what this table is for, and I will just show you, for example, if I was to set this to 0, then it will only include the algos that were determined over here to be included. Dollar yen is being excluded even though it had a good ranking because we are in a very fundamentally negative bear market for the dollar yen because the interest rate expectations in America is now expecting cuts, and this algo only really did well in a bull market. So I think it's until things change fundamentally, this is not an algo that will do well, regardless of its past history. So after I changed that to 0, you could see that the equity curve did dip. This was a screenshot of it from before, but the drawdown in this recent period here was much more muted. Over here, it was still fairly high, but bear in mind, I think that was October last year. Um, that was quite a long period during which the market also went down. And I find that with the pro-real algos, September, August is actually quite a troublesome period for them. So I'm quite happy to actually sit out and only start really putting my money where my mouth is with these from October or November, depending on what the signs are in the market. So plenty of time to still fine tune this and prepare. And in the next video, we are going to really analyze adding the algos one by one, activating them one by one in the spreadsheet and seeing what that does to the equity curve. We will, given that we are running less algos, we might actually increase position sizes so that we run similar levels of risk than were you to run all the algos, and then really prepare ourselves for knowing, okay, how long will the time take to get to our million? Are we happy with that? Do we have a 5-year target? Do we have a 7-year target? And what is the drawdowns that we should expect and can tolerate, and so on. So I think there will be quite a few interesting discoveries that we will make by constructing the portfolio. Um, and I'm looking forward to sharing that with you and even getting your inputs from it as well after I've shared the spreadsheet. Okay, that will be done after part 2 of this video series. Signing out. See you next time.